Hello everyone and welcome to our Q1 2024 Quarterly IFRS Update session. I'm Olaf, a director in PwC's Corporate Reporting Services team, and I'm joined today by Netta and Gary, both partners in the same team. Welcome to both of you. We've got an exciting agenda for you today. We'll be discussing the following topics: net zero commitments and what they mean for IFRS accounting specifically, the importance of quality disclosures, an update to global minimum tax, particularly disclosures here as well, and new requirements that are effective for 2024 year ends. So let's get right into it and start with the first topic. So Gary, net zero commitments, obviously a very topical issue. Many companies disclose net zero targets in their financial statements to be net zero by 5, 10, 15 years into the future. Stakeholders are very interested in this topic, and rightly so. We get questions from preparers often: what does it actually mean for IFRS accounting? Do I need to recognize a provision for all these commitments that I have tied myself into? Is there a slam dunk answer for that?
Well, the answer is no. There's no slam dunk answer for it, and the question actually was recently posed to the Interpretations Committee. So someone wrote in pretty much similar to what you just described there, Olaf. So I think we've got it on the screen there. You have a situation where, if we go to the next slide, it's got a nice picture. You have a situation where a company has basically said, I am in 20x0, I have made a commitment where I'm going to be net zero by, or have reduced my emissions by, let's say, 60% by 20x9. Between 20x0 and 20x9, I now clearly need to do a couple of things before I get to 20x9, and thereafter, if I haven't hit my target, I will buy some credits and I will continue to improve my business. And so the question that the committee was asked is, does an obligation exist, and should you recognize it? And it was actually a really good discussion at the committee. And I think although the committee can't change IFRSs, they can only interpret what's in there. It was really helpful that they clarified or explained some principles as it relates to the recognition of liabilities. And so there were a couple of important things that I think they clarified for us. The first was that in order to have a constructive or a legal obligation, there needs to be a requirement in place. So either it must be legal or constructive. So in the question that the committee was asked, it was specifically on an entity who's made public statements, so a constructive obligation. And I think where the committee got to is they said whether or not you've created this constructive obligation or requirement is actually a matter of judgment, which I think is the right call. With legal, it's a lot easier. Legislation comes out, you know what's happening. With a constructive obligation, I think they said, that would be fact and circumstances dependent. And I think if I'm paraphrasing here, but going back to the words in IS 37, you need to have, through your stated policy or public statements, created an expectation in the minds of third party or third parties such that it would not really be feasible not to do what you've promised to do. And whether or not a company's statements have created that form of promise or expectation is a matter of judgment. But then I think the really important thing that they got onto was to have a constructive or a legal obligation. It needs to be a present obligation as a result of a past event. And I think there was one big takeaway that was, in my mind, the linchpin of this discussion by the committee. It's you need to have that past event. And I think in the example that we've just described here, it's actually the past event is not the statement that you will be net zero. The past event is actually at the point in time where you have said you will be net zero. And so if you think of that diagram that we've got on the slide, I think what's quite important is until you hit that date at which you've said, I'm going to be net zero from now onwards, you do not have a present obligation because the past event has not yet occurred. The past event is not saying I'm going to be net zero or the legislation coming in. It's the date at which you need to be net zero, which is the important point, first thing that they really clarified. The second really good thing that came out of that discussion was, even if I have created a present obligation as a result of a past event, you folks will recall our other parts of the definition of a liability. It needs to be probable that there's going to be an outflow of economic benefits. And so the other thing that the committee got onto discussing when they were talking about this was actually if part of that promise or obligation is to change one asset for another, so I need to buy new machinery or enhance my processes by buying new factory equipment. When there's an outflow, the cash, but the inflow is actually going to be a resource that you control from which you're going to derive economic benefits.
An asset swap.
It's an asset swap. There's no outflow of economic benefits. So I think for me, my takeaway with those are the two really important things that the committee helped folks understand is in the existing literature. There needs to have been that past event in order to have a present obligation, and also there needs to be a probable outflow of economic benefits, not a probable swap of economic benefits. So that's a summary, but as I say, the agenda decisions out there, folks are welcome to read it at their leisure.
Okay, well, thanks. That's very helpful.
We hope so.
Okay. So for anybody grappling with this topic, do I need to recognize a provision, or am I even prohibited from recognizing a provision? Have a look at the agenda papers, some helpful thought processes in there for you to go through. And I guess on a related matter, Gary, we often hear about consistency and connectivity between front half and back half of the financial statements and the annual accounts. These net zero commitments companies often describe in their front half, in the sustainability report, strategic report, etc. How do I link that now in terms of consistency back to the back half, to the numbers?
Yeah, it's another good question, Olaf, and maybe I'll sound like a broken record, because this is something that I think we've mentioned on several webcasts, and I think in our podcast that comes out, it was mentioned in December as well. A key element is this connectivity or consistency between things that you might be saying elsewhere in your annual report or even in your public information and what's in the financial statements. And I think a key message here is, as you mentioned, people are very focused on this at the moment, and what companies and preparers are saying about their transition plans and about their response to climate and other sustainability related topics. And to the extent that there is a large amount of detailed explanation somewhere else in your public information or your annual reports, obviously if there is a corresponding impact to the financials, it's much easier to see that consistency. So you say, as a result of this transition, the factories aren't going to be able to run as long as they were going to, and then I go to the notes on PPE and I see the useful life has been reduced, and someone says it's as a result. Perfect. I think the thing that folks maybe need to also be conscious of is it's where there's something said in the front off, but you don't necessarily see the immediate impact in the financial statements. And this net zero commitment issue we just spoke about would be one perfect example where common sense reader is reading the financials and it says, I'm promising I'm going to do all of this stuff. And I think that's why the submission actually came to the IFRIC. You might expect the common person on the street to go, well, where's the liability? And sometimes I guess the point is you may need to provide disclosures in some cases when there hasn't been a financial impact, so that someone's able to bridge the difference between the two. And we have seen several regulators, they're also getting smarter at reading the entire set of information and ensuring that there's consistency between the two. So again, I think messaging continues. If there's something important you said in your sustainability report, please ensure that the messaging is consistent when we get to the numbers in the back.
So thank you very much, Gary. So that was all about what's happening at the committee level. Is there anything that happens at the board level with regards to this topic?
Yeah, so not necessarily on the specific one, although the board is planning to make targeted amendments potentially to IS 37 in the later half of the year. We'll see what plans they've got. But I think actually at the March board meeting, in addition to that, in response to some of these questions from stakeholders, I think the board is considering some illustrative examples, which basically try and demonstrate how you think about things that may be going on from a sustainability or climate perspective, and how they might either impact the way you think about measurement or you think about specifically the disclosures you might put in the financials. So again, the board will talk about those at the March board meeting, and I think the proposal is to actually expose those illustrative examples in an exposure draft and see what folks think. But again, the idea behind it is to try and again get people to start thinking about what disclosures do you need to put in your financial statements when there are material events or transactions occurring from a sustainability perspective. So I think watch the space. There's still things to think about.
Okay, very helpful. Thanks very much, Gary, for this. Let's move over to our second agenda point now. And Netta, this is one for you on the importance of quality disclosures. Perhaps you can outline the sort of more general objectives and purpose of disclosures in financial statements more broadly.
Thank you, Olaf. So this is actually something that I'm passionate about. So let's talk about importance of quality disclosures. And maybe quickly just to summarize some of the main objectives of financial statement disclosures. So I think everybody remembers that entities are required to disclose the material accounting policy information, which is obviously information that can reasonably be expected to influence the decisions made by the users or investors. In addition to that, entities need to describe judgments made by managements in the application of these accounting policies, and that have also the most significant effects on the amounts. Then further, entities are required to disclose information about assumptions and major sources of estimation uncertainty that have a significant risk of resulting in a potential misstatement for the carrying values of assets and liabilities. So in my view, preparers should pay attention to not only the specifically listed disclosure requirements in the accounting standards, in the specific accounting standards themselves, but also keep in mind the IS1 kind of overarching requirement to provide additional disclosures where it's necessary for the users of the financial statements to understand transactions or events of the reporting entity. So, not just stick to what is said in the standard, but really pay attention to what's going on into the company. So this is really tied to the overall purpose of the financial statements as a whole, to provide information that presents fairly the financial position, the financial performance, as well as the cash flows. And on that note, I think the additional disclosure where it's necessary is required in order for a user or an investor to actually form an understanding that can impact its decision making. So, in my view, disclosures are actually a great opportunity for management to tell the entity's story and tying it back to other forms of investor communication. A great example, what Gary was just mentioning about, the climate-related issues between the front and the half. So in other words, it's an opportunity to reflect in the disclosures all these material items that are relevant to the company in order to present a transparent picture of what's going on in the entity. So what does that mean in practice? I think we would not expect disclosures to describe identical events, circumstances, or conditions from a period to period. But we would rather expect that fresh eyes in the entity would actually review what disclosures are necessary in that specific reporting period to meet the requirements, and taking into account the overall objectives that I just mentioned about in that sense. So I think drafting high quality disclosures should not be thought of as a rolling template of a boilerplate qualitative disclosures. I think we find it's very common for companies to leave the updating of their disclosures until very late in the financial statement reporting process or in the preparation process. I think it can sometimes then result in rushing through the disclosure update process and potentially not be fit for purpose, taking into account what's been happening with the companies. So I don't know, Olaf. I mean, you and I, we work with financial statements. So what do you think about?
We do a lot of reviews, right?
Exactly.
And I think it's probably maybe now for December year, and it's actually a good time for preparers to say, well, look, the really busy period where we've prepared and we've just gone through the audit, it's probably a good time to take a step back, reflect, and use a sort of maybe less busy period to really critically challenge yourself whether the disclosures that you have are actually fit for purpose, right?
Thanks,
so
I think it's a great advice.
A good time now to do this. And I think you've prepared a nice slide here, Netta, like these three boxes here, kind of maybe give management a little hint on what could be triggering events for them to realize, hey, maybe I should do something about my disclosures to make them more useful.
Yeah, exactly. Thanks, Olaf. So I think we tried to kind of categorize under three buckets some of these triggering events, if you will, as you stated, about conditions or situations when entities should think about, uplifting their specific disclosures. And I think we categorize these events under the internal events. So obviously, as a result of anything happening within the entity internally, the existing disclosures from a prior period might not be sufficient any longer. And such events can be obviously new transactions. An entity can enter into a new large financing transaction, a sale and leaseback transaction, or a new type of an incentive arrangement, material transactions. A good example, I think, what regulators are really paying attention to are material related party transactions. So that's something to keep in mind, just as an example. Obviously, business combinations, acquisitions, or disposals are events that would probably require, uplifting shifting in the disclosure, further changes in the structure, the new business model, for example, for revenue streams, or changing the way the CODM manages the operations or potentially closing a business line. So I think all these internal events that happen within the entities need to be pay attention whether those would trigger then updating their disclosures. Obviously, external factors, and we've been living very turbulent times, so I think also not only to the external factors, but this also relates to the regulatory environment. So I think expanded or tailored disclosures or even completely new disclosures might be needed to explain the impacts to the entity's financial positions and operations, and especially the risk exposure, if I may say.
Or even updating your critical estimates and sensitivities,
critical estimates,
right?
absolutely.
So it may not even be the same last year to this year because of the change of environments.
That's correct. So I think we've been living through very, very volatile macroeconomic conditions. So changes in interest rates, inflation, hyperinflation, and now obviously if conditions stabilize, that also needs to be then reflected in the disclosures. Yeah. I think we've been seeing a lot of geopolitical conflicts in the global environment, and obviously either direct or indirect impacts of these type of situations, including sanctions or disruptions, may actually trigger new disclosures. And I think lastly but not least, it's the regulatory environment. So obviously new legislation, for example, the Pillar 2 tax legislation, but also I think the regulators around the globe have been paying a lot more attention lately on the adequacy of quality and transparent disclosures around these macroeconomic and geopolitical conditions. So, and obviously you can name different regulators around the world, but I think I just wanted to pick up what FRC in the UK has stated, because I think this is fit for purpose, and they've actually laid out 3 kind of main objectives in terms of the disclosures, with the first one is being that they require entities that their disclosures regarding uncertainty meet the relevant IFRS accounting requirements. So I think this is very spot on if we think about the macroeconomic conditions. Mm-hmm. And number 2 is provide transparent disclosure of material risks arising from financial instruments, which is, I think, something that we see all the time and something that has been on ESMA's focus areas for years now. And I think lastly, the third point that they have said is that they require entities to consider that the interim or financial statements are clear, concise, understandable, and they actually include all information necessary to understand the applicable transaction events and circumstances impacting the entity. So that again goes back
It's a good point, right? I mean, management and preparers, they know the company inside out, right? For them it might be very obvious and maybe not much more needs to be said, but a reader of the financial statements doesn't have any of that background. They start from fresh and they need all that high quality disclosures to actually understand the story.
That's correct. And I think it's been interesting to see like how ESMA has published findings in its enforcement databases where the accounting might be correct, but they've actually told the preparer that their disclosures are not adequately reflecting the underlying accounting for that material event. So in that sense, I think entities really need to pay attention to the quality of their disclosure. So maybe the last point then is obviously, or the last category that we brought up is changes in accounting standards. So obviously we've got newly required disclosures coming, resulting from new accounting standards, and also entities might change their accounting policies, and then they need to disclose what is the impact for the current period and also for the future periods. But maybe this will, of course, back to what Gary was saying.
It does kind of go back to Gary's net zero commitments, right? So there might be now situations where the business model slightly changed for a company and they say, look, we want to be net zero, but in order to achieve that, we need to maybe invest in some more offset certificates. Mm-hmm. And maybe there was no policy before because it just wasn't material, but now it starts to become material, more significant. So companies should develop a policy, explain that very well, because there could well be some judgment. Is that offset certificate an IS2 asset? Is it an IS38 asset? Mm-hmm. Do I fair value it? Do I not fair value it? So there could be lots of things that would be of interest for an investor for a material new asset that is on the books. So again, thinking about this trigger is actually quite helpful here.
Yeah, and I think maybe one point, just thinking of the buckets that Netta laid out, which I think are really useful. I think it's just also useful to note that the middle bucket is sometimes the more difficult one from a process perspective to put in place. Because if you think about it, if you have a big business combination or restructuring, there's a lot of people working, a lot of finance people working on it. It's easy to know that it's in the financials. Change in accounting standard, you know that's happening, but I think sometimes those external events, although you may have considered them, as you said, Olaf, have you thought about the changes in your estimates, and have you thought about updating them? Have you thought about the ranges of estimates that you used and whether or not they've gotten bigger or smaller as a result of macroeconomic conditions? So I think if it was me, I'd say the bucket 1 and 3, probably easier to put a process around. Bucket 2, maybe a little bit more thought would be required by entities to make sure they don't miss any of those.
Yeah, it requires more linkage between what's happening at the C-suite level to take into account these conditions and then reflecting them also in the financial statements. So.
Yeah. Okay. Yeah. Well, thanks very much. I hope that was useful roundup on the importance of high quality disclosure. So maybe we go over to our third agenda point now. It's the global minimum tax, and it kind of runs with the theme of disclosure scare, right? Because luckily we were given an exemption from actually having to calculate deferred tax on this global minimum tax, but still lots of disclosures are required, right? Do you want to take us through those?
There's never any exceptions to measurements or recognition without some disclosure that picks up the slack. So so I think folks may recall when it came to global minimum taxes or Pillar 2 taxes, the ISB last year issued the exception which said, thou shalt not book any deferred tax or provide any deferred tax disclosures related to Pillar 2 or qualifying domestic minimum top-up taxes. I think on the slide we call it QDMTTs, so that's what it stands for. But as you said, the disclosure that came along with that was, if it's been enacted but not yet effective, you need to start providing disclosures around what you possibly think is going to happen. If it has been enacted and it is effective, you need to separately disclose how much was the normal tax versus the Pillar 2 top-up. And actually, we've also included a link in the slide that if you want to see what the enactment position is for any country around the world, there's a really cool interactive slide. You can click on a country and it says what the current situation is for both IR and UTPR. So for folks who are interested, I had to play around. It's actually quite a good. If you want to see what's going taxes wide worldwide, you can click on a whole lot of countries. So we put that on the slide. But I think in terms of, because that was year end, and I think folks are pretty much done with that. I think for purposes of interims, what folks maybe need to think about is there's no specific requirement for Pillar 2 with respect to interims, and so the general principles in IAS 34 would apply. So you're thinking about whatever you said in your annuals, has there been any really big change since then? So maybe you said something was, it was inactive, but it's not yet effective. It's now become effective, and I've now calculated that this is the interim amount that I think I might be subject to. If a new country that you operate in has adopted, and it was a relatively low rate tax-paying rate before, and now you think it's going to have an impact, you might want to disclose that. So again, I'd say, just like you go through a normal process for interims, Pillar 2 is in the mix, and you need to, and because things are changing quite often there, I think it's something that folks should hopefully have a think about when they come to their interims. Yeah,
it's probably fair to say that companies are still on a learning curve here, right? It's similar to all the climate disclosures we had starting a couple of years back. Companies are getting better and better. I think we expect the same here, right? Yeah,
that's exactly right. So if you look at the year-end reporting, I think folks would clearly have said, that they've applied the exception, because you had to say that, why you wouldn't. But then in terms of, as you say, Olaf, the disclosures around where are you on your journey, I think it's fair to say folks are still at a relatively earlier stage. So, the disclosure around your expected impact, a lot of folks saying these are the countries where the effective tax rate's lower than 15, so likely to be impacted. Some have said, we've already started the assessment, and we think there'll be a range of changes between X to Y percentage in our effective tax rate. But I think that's probably where folks have broadly, the disclosures were at your end. And as you say, as we go on the journey and you get closer to D-Day, I imagine folks will have a little bit more granularity. So again, the idea would be we would expect more and more specificity on those disclosures as we come closer to actually paying the top-up tax. Yeah.
Great. Okay. Is there anything else, Gary, you wanted to tell our viewers on deferred tax?
Oh, lots of stuff. Lots of stuff. That it's very hard. No. So there's a couple of things on the slide there. I think just that deferred tax changes arising from tax legislation that do not qualify as domestic minimum top-up taxes or Pillar 2. So you're seeing quite a lot of entities, countries, actually change their existing normal tax, ordinary tax regimes in anticipation of Pillar 2, and that can actually kick out new questions around if you were paying zero before, you're in a zero rate tax regime or low, and the normal rate goes up, what does that do to all your deferred tax balances? So have a think about that. Potentially need to book deferred tax on things that you never had in the past, and the initial recognition exception may not apply. New taxes. So we're seeing, obviously, Netta was pointing out a lot of geopolitical headwinds, economic headwinds. A lot of tax fiscuses are looking at innovative ways where they can recover tax from some industries that are doing better than others in these times. And so we're seeing a lot of things that are either called taxes but aren't in the scope of IS-12, or called levies but may or may not be in the scope of IS-12. So again, if you see something where you're paying money over to the government, it's worth having a think about, is it a tax or not, because it changes measurement and disclosure. And the last thing is also just reassessing the recoverability of your deferred tax with all of the changes and uncertainty, as well as all the tax changes, whether or not that has an impact on your existing deferred tax balances.
Okay. Thanks very much, Gary. Difficult topic, lots to think about for companies, lots to do still. Let's move over now to our fourth and final agenda point. This is on new requirements effective for 2024 calendar year end. So, Netta, I'm going to pass this back to you. There's no big new standard this year, but there's a couple of small amendments, right, that definitely companies need to be aware of, right?
That's correct, Olaf. Agree. So there are no new standards effective in 2024, but there are some amendments which might very well be relevant for many entities in 2024. So we'll cover the three here. So the first one is supplier finance arrangements. I think, as you may recall from our previous webcasts, last year the ISB released the amendments to IS7, IFRS 7 to improve the disclosure requirements around supplier finance arrangements. So this amendment is effective for reporting periods starting January 1, 2024. So it introduces a number of disclosure requirements for the buyer when it is a part of a supplier finance arrangement. I think with this amendment we have some good news in terms of the application requirements. So I'll come to those in a minute. So some of these actual changes in the disclosure requirements require entities to disclose terms and conditions or information. For example, where the liability is presented on the statement of financial position, how much of the liability was paid by the bank to the supplier, and so on. And as I said, there are some good news to these disclosure requirements. There is a transition relief for interim periods in the first year of adoption. So entities are specifically exempted of providing the required disclosures on supplier finance arrangements for the interim financial statements. And there's also further good news in that sense that comparative information at the beginning of the year of adoption is not required. So this actually means that this is really relevant now for entities when they start to prepare their annuals first time for December 24 year end. However, I think we still want to remind people that even though you're not required to disclose anything until at year end, we think that entities should already be reviewing the arrangements and the processes, because some of these new disclosure requirements may actually trigger the need to gather more information from the financing entity, which they don't have access to currently. And actually, some of the contractual agreements with them may actually even need to be amended so that they specifically cover that information. So I think in that sense, even though we are not required to disclose anything for the interim periods, preparers should actually start preparing for the annual in that sense. And I think the second one is the lease liability in a sale and leaseback transaction. If people remember, when originally issued, IFRS 16 didn't include specific subsequent measurement requirements for sale and leaseback transactions. And consequently, it wasn't always clear how to subsequently measure the liability that arose from a financing transaction. And particularly where the payments for the lease include payments that do not meet the definition of lease payments in IFRS 16. For example, variable lease payments that do not depend on an index or a rate. So as a result of this, the ISB issued very narrow scope amendments to the requirements for sale and leaseback transactions in IFRS 16, explaining how a seller lessee accounts for a sale and leaseback post-transaction, so post the initial entering into that sale and leaseback transaction. And it's fair to say that these amendments only impact a seller lessee's accounting for a sale and leaseback transaction that satisfies the requirements in IFRS 15 to be accounted for as a sale. And they don't change the accounting for leases other than those arising in a sale and leaseback transactions, nor do they change the accounting for the buyer lessor.
Yeah.
But I think here then it's fair to say that people need to pay attention because the entity applies the requirements retrospectively to sale and leaseback transactions that were entered into after the date when the entity initially applied IFRS 16. So, for example, if an entity that initially applied IFRS 16 in January 2019, which I think most or many IFRS reporters did, they would need to apply the amendments to sale and leaseback transactions that were entered into after January 1, 2019, i.e. the initial adoption. So
quite onerous, right?
That is quite onerous, and obviously, hopefully, people have good audit trail and track records of all of these transactions. And then I think in that sense, we've got a good in-depth out there, and it's it's presented on the screen. So if you want to go and refresh your memory, it's a good piece of guidance to go and review. Then lastly, it's IAS 1 amendment with respect to non-current liabilities with covenants. So in October 2022, a year before, the board issued new amendments to IAS 1. And this was in response to concerns which were raised on applying the previous amendments that the board did in 2020 with respect to the classification of liabilities as current or non-current. These new amendments really aim to improve the information an entity provides when its right to defer settlement of a liability is subject to compliance with covenants, which is obviously something we see a lot in the marketplace. So the non-current classification is based on the existing rights at the end of the reporting period and whether those rights allow the entity to defer settlement for at least 12 months after the reporting period. And this would be the case even if the entity needed to comply with conditions after the end of the reporting period. So I think, Olaf, when we chatted about this is kind of like the balance sheet date view, if you will. So we look at the conditions existing at that date. Yeah. And I think on that note, then covenants that an entity is required to comply with after the end of the reporting period are not considered when we determine the classification and whether they have a right to defer settlement for at least 12 months after the reporting date. And I think further, it's important to note that this classification is not impacted by management intentions or expectations. So if the entity would exercise the right to defer settlement, or if they've actually settled the liability after the end of the reporting period, but before the financial statements are authorized for issue. So it's important to note. Yep. And again, we go back to disclosures. I think today has been a lot about disclosures, yes, but and I think this is very important. So there are additional disclosure requirements that have come into place after the amendment to IAS 1. So first of all, facts and circumstances type, so if any, that indicate that the entity may have difficulty in complying with the covenants, is a new disclosure requirement. And I think the other major one is also that if there's been a settlement after the reporting date of a liability that was classified as non-current at the reporting date. So pay attention to these, and I think covenants exist in the marketplace, so there's something to do around that. I think lastly, I know it's not on the slides, but there are some amendments, Olaf, to IAS 21 on lack of exchangeability, which has an effective date of January 1, 2025, but they are available for early adoption.
Okay. So great. Yeah, thanks very much. Thanks very much, Netta. So that was a short summary of the new developments for everybody. You can obviously refer to the previous year webcasts that we had to listen in more detail to some of these amendments. We've been through some of those before. Or you can just refer to our comprehensive guidance that's available on Viewpoint, which is our knowledge management base. And you see them on the slide here, a couple of references there to some of the topics that Netta talked about. So we've covered quite a lot of ground today. Hopefully you found this update useful. I would like to thank Netta and Gary for sharing your expertise with us. And thank you as well to the audience for listening in to us today. And stay tuned for our next update, which we have in early summer. And that just leaves me with wishing you all a nice day. Thank you.